And that does it for today's market action. Closing off the lows of the day. Dow, S&P in the red. Dow off 142 points. S&P off about 0.3%. The NASDAQ barely holding on to gains, up just 3 points, basically at the flat line. For more on this, we want to bring in Ross Mayfield, Baird Investment Strategy Analyst, and Julian, Brigden, Macro Intelligence, two partners, co-founder and president. Julian, first to you. We had the worrisome inflation number paired with the bank earnings, JP Morgan and Morgan Stanley missing there, some weakness in their investment banking sectors. What do you make? What's your big takeaway from the action that we saw today?
Not really. I don't know whether there is one. I think it's really noisy as we sit here, to be brutally honest. I think if you look at, most of the gains came, as you said, we opened the day really poorly on the JP Morgan news, poor news out of Asia, I think, as well, overnight. And then we got these less hawkish, let's call them, comments from two Fed officials. And if you look at the timing of when Chris Waller was talking or Bollard, both of those who both affirmed that we're looking at a base case of 75 and not this sort of 100 that I think it was Nomura who sort of started that rumor. The market grabbed onto that and sort of saw, here we're safe. I don't think it means that at all. But, that's what day trading as you head into earnings could produce.
So then, Ross, when you do have this much noise, obviously a lot of data points coming at people at the moment, what are you focusing on in terms of what's informing your market strategy right now?
Well, right now you have to focus on the kind of the big things that matter, right? And for the market, that's earnings as we enter into earnings season, and particularly guidance. I think there's kind of a pretty broad consensus that estimates have to come down to reflect a slowing economic environment. The question is just how much do they have to come down? And we're starting to see results and guidance trickle out that will give a better picture of what 2023 might look like. On the other hand, you have to watch inflation and you have to watch the Fed. So, we have the inflation report from June that was obviously hotter than expected and now has started the rumors of the 100 basis point rate hike that were mentioned. But at the same time, you have commodity prices softening a bit. You have a lot of things kind of working together. So you want to focus on earnings and inflation, and basically everything else is noise.
And Julian, back to your comments from the Fed, in particular from Fed Gov Waller, who did say, 75-point basis case, but open to something larger. And he said that markets are beginning to price in a 100-point hike. What's the risk in tightening too fast?
I mean, clearly the risk is they'll tank the equity market. I mean, really, we've talked about this before, how you've got this acute financialization where we think that logic would dictate that the real economy dictates what happens in the equity market. It actually isn't like that. It's actually the equity market that really dictates what happens in the real economy through the behavior of CEOs who are just paid to push up their equity price. And so the minute that their equity price starts to fall, they run into the cost-cutting cupboard and come out with the axe and start hacking people and hacking CapEx. And we can see it already in various announcements we're getting on the labor side that companies are starting to get concerned about that. And taken to its fullest degree, that's going to be a self-fulfilling prophecy. So I think the risk is that, maybe that's not the case, right? I'm not an equity guy. I think, there is a possibility that some of these earnings, we built in a lot of negativity. Some of these earnings might surprise at least for this quarter, but the key is going to be looking forward. And I think in certain sectors, there are some real problems starting to build. Does that really manifest itself this quarter, or do we have to wait for the classic kind of September, October when we get the next leg down in the market? Possibly, but I think you've got to be open to that risk right here, right now.
Hey, Ross, I'm curious to get your perspective on that. When you take a look at the market, what's been priced in at this point? Lots of talk now in the last 24 hours that we could see a 100 basis point hike. How much of that has already been factored in?
Well, on the side of the Fed, the 100 versus 75, I mean, it matters on the margins, but it doesn't matter for the broader narrative, right? It's just Fed very hawkish, going to hike interest rates until they can kind of break the back of inflation. The path of Fed fund futures didn't necessarily change all that much. You still see kind of a peak in the first half of 2023, followed by rate cuts into the back half of the year because the market expects, the Fed and other forces to conspire to a recession in the US. So it hasn't shifted kind of the path of rate hikes much. Maybe the terminal Fed fund rate is a little bit higher if they do 100 next time and then start looking at 75 in meetings after that. But the broader kind of path hasn't changed. What's priced in? I mean, at worst, we were down 23-ish%. That's looking at kind of a mild earnings recession, a milder recession if you just go back to what equity market solves around recessions have looked like historically. I think at the very least, you're going to see continued volatile chop sideways. There's just very few opportunities for a catalyst higher, where there's still enough headwinds that there could be a catalyst lower, whether it's, into late summer or fall, before, the market kind of settles up and can possibly sustain a rally.
And Julian, a lot of people are probably wondering, look, how can I recession-proof or inflation-proof my portfolio at the moment? You said there were some sectors that you definitely weren't that interested in. What are some of the ones that you are interested in?
It's a great question, and I think it's a valid question, and people obviously sitting at home quite concerned. I mean, I've been dipping my toe for the first time in a very, very long time. I mean, best part of 18 months, 2 years into the front end of the bond market. I think, whether it's sort of 1 year or 2 year stuff, I think it's right that the market is starting to question, as Ross was suggesting, quite how far those interest rates are going to go because the risk of recession is rising. And so I think that's a safe place you can put stuff. I quite like energy longer term. I like metals and mining longer term. But it's very, very hard to buy anything in a market where the broad market is going down. So really, I don't think there's anything wrong having cash. I've been advocating to clients since November to have some cash, right? That's what you want at the lows of the market so you can deploy your money and buy very, very cheap assets. And so outside, if people don't want to short anything, I really am limiting myself to cash and to 1 to 2 year treasuries.
And Ross, your strategy, given all the headwinds we've discussed here?
Sure. So on the equity side, I think it's a very similar sentiment, right? In the near term, you want to be playing defense still a little bit, given the shift mix of headwinds versus tailwinds over the next 3 to 6 months. So what does that look like? Kind of classic defensive sectors, right? You saw staples and utilities outperforming today. Healthcare. We do like energy as well. I think there's some really structural issues on the supply side, even though the sell-off of late has been pretty pronounced and there's a lot of demand destruction being priced into energy stocks and oil. I think there's still some structural issues that would lead to kind of longer term leadership here. But longer term, zoom out. I mean, we still want to own kind of secular winners and some growth. I think to question the ultimate, high point in rates, it's still pretty low versus history. And so when you kind of get back to maybe a more normal environment a couple years down the road, maybe medium inflation, medium to low rates, I still think you need to own some equities that bring their own growth to the table. And after this kind of sell-off has shaken out the weak hands, I think you can start to find some quality at a discount in those sectors.
Well, we do thank you. That's our market panel there, Ross Mayfield and Julian Brigden. Thank you both.